So if you ask around about accounting, say you're a freshman and you ask around, you'll find out that everybody says if you're going to do accounting, you should do it with him. His classes are packed. He makes it hard because he does it early in the morning, and they're still packed. And he is so some of you are going to view accounting sort of like medicine that you have to take, and if you have to take the medicine, this is the best way to take it. But I suspect more of you will get a little taste of this and say, you know, I might not want to become an accountant, but this is something I really need to know. And I know you're often hearing on the cell phone from somewhere else like home, well, why don't you take some accounting? So at the very least, you're going to be inoculated, because those of you who decide not to take accounting, when someone tells you you should take accounting, you can say, well, I had a couple of sessions of accounting, and it might help. So without further ado, I want to introduce really one of the really great teachers on this campus, and clearly the person I know who's most passionate about accounting, C.J. Skender. Welcome.
Thank you.
Thank you.
You're putting a lot of pressure on me, Buck, if I can handle all this. I'm going to teach you in the next 60 minutes a semester's worth of financial accounting, so I'm going to have to talk fast, okay? Okay, let's go. Financial accounting, to give you some, that's my outline, institutional information. Understand, and we'll do 90 seconds of accounting history, just so you've been exposed to a couple names. The fellow who started it, I like that, was a monk named Luca Pacioli. The year was 1494. All right? Now, accounting existed prior to Luca. The ancient Babylonians, Egyptians, Sumerians, they all did accounting. There's accounting in the Bible. But this little Italian monk, Sicilian, started writing about it in 1494. All right, so 520 years ago, 18 years ago. Accountants should be able to count. 518 years ago. And Luca used words in his writings like deberium and creditum, and from that you get debits and credits. We'll talk briefly about debits and credits as we go through here. But understand that he was the person who started it. There weren't CPAs in our country until the late 1800s, early 1900s. So accounting is very young, say, compared to medicine or compared to law. Probably interested in who writes the rules or who's responsible for accounting. Well, currently it's a group called the FASB. Okay, the FASB makes the rules. FASB stands for Financial Accounting Standards Board. It's B-O-A-R-D. All right, and they're the group located up in Connecticut who makes accounting rules. They've been in existence since the early 1970s. The thing that you need to understand is they don't just walk in on a Monday morning, grab a cup of coffee, and say, let's make some accounting rules. They actually go through a long, detailed, drawn-out process. They will issue a discussion memorandum. People will comment on it. You and I could comment on it. They'd read it. They'd consider it. Then they issue an exposure draft. Then they take a vote. Then they issue an official pronouncement of the FASB. 7 individuals headquartered up in Connecticut. If we had the time, would go up there and watch them make accounting rules. That would be a hoot. But they don't have the congressional power. The congressional power rests with the SEC. Okay, the SEC is an abbreviation for the Securities and Exchange Commission. All right. If there were ever a disagreement between the SEC and the FASB, the SEC would win. The SEC has the power, but they've basically given the power informally to the FASB. All right. Public companies, companies whose shares are publicly traded, have to file reports with the SEC. All right. Every year, they've got to file what is called a 10K. All right. In that 10K are the financial statements that we're going to talk about. So we've got the FASB in Connecticut, we've got the SEC in Washington, D.C. I had a student, this is probably a dozen years ago, but gave an essay exam, asked about the SEC, and I got this brilliant, well-written paragraph about Florida and Kentucky and LSU. I was looking for the SEC as it relates to financial accounting. Let's go from there, and let's take a look at these financial statements, because that's really the meat, or if you're vegetarian, asparagus of what we're going to be doing today. Thank you. Appreciate that. Next time I'm on amateur night, I want you in the front row. We've got, and I have them listed up here, and I don't know if you can read that. I included in the stuff for you 4 pages from the 10K of Starbucks, 4 pages from the 10K of Walmart. Just so you could see examples of an income statement, a balance sheet, a statement of cash flows, and a statement of owner's equity. And I'll ask you to look at those in a little bit more depth for when we meet again in 2 weeks. But I just want to give you a broad overview of what a company does. And as an entrepreneur, you're going to have to put together financial statements or have your accountant put them together. So you want to have a working knowledge as to what they relate to or what they mean and deal with. You need a couple of definitions first. I've listed 5 items up here that I'll define for you. First of all, revenues. Revenues represent an increase / inflow of net assets. Had breakfast at Waffle House this morning. Tasted great the second time. From providing goods it had an A rating, so. And or services. An increase / inflow of net assets from providing goods and or services. Those are revenues. Second term, expenses. An outflow / decrease, to compare the inflow and increase of net assets from providing goods and or services. So if you start a business and you sell a good or render a service, okay, whatever you charge for that is called revenue. What you pay for the goods you're selling, that would be an expense. What you pay to your employees, your salespeople, that would be an expense. You probably want to know what we mean by net assets. Net assets are equal to total assets minus total liabilities. Well, you can look on page 43, that's the first page that you have of Starbucks income statement, or 32, these are the pages as they have them numbered in their reports, and see an income statement, and they've got lots of revenues and lots of expenses listed there. All right. You'll see taxes. All right, here's the soundbite. Here's what you should remember about taxes. Taxes make the good times not as good and the bad times when in Rome, not as bad. Stay classy. If you get a job working evenings and you make $1,000, you're not going to have that $1,000 because taxes are going to eat away 20%, 30%, some amount of that. But on the other hand, if you encounter a loss, if you take your life savings, $20,000, invested in a surefire can't-miss startup, figuring you're going to be a millionaire in a couple of years, and it doesn't happen, now your investment of $20,000 is worth $1,000. If you sell that investment, you've got a $19,000 loss. You can use that to offset other income, so the bad times are not as bad. When you try to describe that to your SO, all right, significant other, you say, look, honey, we've got a great tax loss here that we can use to offset other income. And the excitement continues to build. All right. On the next page, I'm going to define for you assets in 2 words. Assets are equal to economic resources. If you look on page 44 of Starbucks or 33 of Walmart, you'll see cash, you'll see investments, you'll see receivables, land, buildings, machinery, equipment, all of those are assets. They even have intangible assets. Patents, copyrights, goodwill. Intangible assets are things you can't touch. They have no physical substance, but you paid for them. Think of a patent. Yeah, you paid for it. It protects you, it allows you to do something. It's an asset, it's an economic resource. Liabilities, in 2 words, creditors, claims. Again, looking at page 44 or page 33, you can see accounts payable, salaries payable, interest payable, taxes payable. Those are all liabilities. Those are things that the business owes. And then finally, you've got owner's equity, which is equal to owner's claims. Whatever the owner's invested in the business. I should talk about different types of businesses that are out there. There's something called a proprietorship that you can think of as a one-woman, one-man, one-person show. If you start a business, if I start a business, and we do it all ourselves, we make the investment, that can be a proprietorship. All right, whatever money the business makes goes to your 1040 and a Schedule C on the tax return, and that's how you pay your taxes on that proprietorship. If Buck and I go together and form a business, we might form what is called a partnership. 2 or more individuals doing business to hopefully make a profit. Partnerships aren't limited to 2 partners. Right? Some of the large law firms or consulting firms, accounting firms, have partnerships of 2 and 3 and 4,000 people. But the dominant form in our society is something called the corporation. Corporation is Starbucks, it is Walmart. Corporation sells shares of stock. All right? And they take that money that they get from those shares of stock, those are their assets, and they invest, all right, to try to make money, to try to make a profit. The C corporation, called that just because it's in Chapter C of the Revenue Code, Internal Revenue Code, is for the major, the large corporations, but you also might be familiar with something called an S corporation. A lot of family businesses are arranged as S corporations. All right, so there are different types of owner's equity that you can be exposed to. You've heard of limited liability companies as well. It's another form of owner's equity. All right, well, these accounts, the revenues and expenses from the prior page, the assets, liabilities, and owner's equity from this page, essentially give us a couple of formulas that allow us to do the financial statements that we look at when we look at financial information. Bless you. Did you have your flu shot yet? No. Better get it. Just go to Rite Aid or Walgreens or CVS, wherever. Get your flu shot. Okay? Don't want you spreading germs. That would be horrible. All right. The income statement. All right. The income statement measures something called net income. I'm going to abbreviate at some point. If you don't know the abbreviation that I'm using, just yell out, "Hey, what's that?" IS is for income statement, and I is for net income. Net income is equal to revenues minus expenses. All right. Well, let's assume that we have revenues of $1,200. And let's assume that we have expenses of $1,055. What is your net income? Anybody, just yell it out. Or what time do you wish it were? 1:45. Good answer. Good answer. Like the way you think. I'll be watching you. Net income is nothing more than revenues minus expenses. Look at Starbucks, look at Walmart, revenues minus expenses, that gives them their net income. For this thing that we call the balance sheet, think of that as a scale. And on this scale, we have assets equal to liabilities and owner's equity. The resources, the assets, are equal to the claims on those resources, the liabilities and the owner's equity. Assets equal liabilities and owner's equity. Resources equal claims on those resources. Suppose I told you that assets were $900, liabilities were $240. What is owner's equity? $660, the fan. Anybody listen to AM radio? Just about everybody. Good. That's a sports talk station in New York. Okay. They have A-Rod leaving town, I think. Anyway, tough last couple days for him. You guys follow baseball? Does the name Pavlov ring a bell? I like you. There are two other statements that I'll mention. We won't do a whole lot with them today. A statement of cash flows looks at changes, it's David Bowie, changes in the cash account. And it measures these changes through operating activities, investing activities, and financing activities. If you flip to page 45 for Starbucks, 35 for Walmart, you can see a statement of cash flows showing how the cash changes. That's an important statement. All right. Cash is king. It's another soundbite for you. Cash is king. Not Richard Petty. Cash. Not Johnny Cash. Cash. All right. So who went to the state fair? Did you see the girl wearing the t-shirt that said, "I'm with stupid, S-T-O-O-P-I-D," and it was pointing at her date? I thought that was so cool. Guess she had to be there. Okay. And then the fourth is something called a statement of owner's equity. The statement of owner's equity simply shows the changes in the owner's equity up there. How did it start? What did we add to it? What did we take from it during the year? So those are the four major financial statements. If you recognize them by name, you're in good shape. The first three are connected, if you can see this picture, but a balance sheet measures a company at a specific point in time. One date, my freshman year in college. Okay. January 1st, December 31st. Click, it's a snapshot of a picture at one date. Connecting those are two flow type statements, income statement for the year ended 12/31 and statement of cash flow for the year ended 12/31. They're connected. They fit together. The financial statements are really the meat of today's lecture, just seeing how they're connected and how they fit together. They tell a story. Right? There are also footnotes that are associated with those financial statements. They tell a story as well. Always read the footnotes. Right? They're going to give you a lot more information than you have just by looking at the numbers. So that's an important issue as well. All right, if you get past those first 8 pages that I have there with Starbucks and Walmart, there are a series of questions, 5 pages of questions that we can run through together to get some insight, understanding, reinforcement of what it is we just talked about. All right, first it says identify 2 examples of assets. Cash is an asset. Inventory is an asset. Accounts receivable is an asset. Land, buildings. Lots of examples that you could pull right off of Starbucks or Walmart's statements. 2 examples of liabilities. Accounts payable, notes payable, taxes payable. 2 examples of revenues. Sales would be an example of a revenue account. If you're a landlord, you'll have rent revenue. If you're a bank, interest revenue. 2 examples of expenses. When we think of expenses, salaries expense, cost of goods sold, what it is you sold, that's an expense. Commissions expense, if you're paying somebody a commission to make the sales. So looking at the financial statements, the 8 pages that you have are going to give you answers to those questions, plenty more than 2 examples, but we just want to kind of do a drive-by shooting of these things. Then we talked about net assets. Net assets are anybody? Bueller. Total assets minus total liabilities. Could you think of net assets another way? How else could we define net assets besides total assets minus total liabilities? And I'm going to give you R, S, T, L, N, and the vowel E. Whoa! With authority. Yes. Owners, where's my man? Looks like you need a Snickers. Wait a minute. What do you model, gloves? Here, have a Snickers. You look like you're hungry. Owner's equity is the same thing as net assets. So when we define revenues and we say that it's an inflow or an increase in owner's equity from providing goods or services, expenses, outflows, decreases of net assets from providing goods and or services, owner's equity is also net assets. Are you with me? Because if you're not with me, you're against me. All right, then it asks, how do revenues occur? Now, you could have revenues occurring if assets go up or if liabilities go down. How do expenses occur? If you have a decrease in assets or if you have an increase in liabilities, those are things that can cause expenses. Balance sheet accounts are referred to as real or permanent accounts. All right, so assets and liabilities and owner's equity are real. They're permanent. And all that means is whatever their ending balance is one year, that's the beginning balance the next year. So whatever's in your cash account at 11/59/59 on New Year's Eve is the same amount that's in your cash account at 12/00/01 on January 1st. Happy New Year. The nominal or temporary accounts, those are going to be the revenues and the expenses. And the reason for that is that we're going to close them each year. We're going to make them zero, and whatever that net income number is, that's going to become a part of owner's equity. Are you feeling it? Living it, loving it, learning it? Yeah. Yeah. Okay. Does that sound like Little John? Okay. Anybody's birthday today? We can party like it's your birthday. Sip Bacardi like it's your birthday. Today's a big day for me. 36 years ago today, I had my first date with my wife. Isn't that cool? Yeah, great, thanks. Here's the problem. I showed up 2.5 hours early. Late. Hate it when that happens. Twisted. I got there at 8:30. She said, didn't we say 6 o'clock? I said, I thought we said 8:30. Smart woman, though. She waited. She was wearing red. Oh, that's a hot color. Yeah. Thank you. I told her that I really was supposed to be there at 6 after her third scotch and water. That's when I felt that she could handle it. All right, let's look at these problems on the next page. They're quickies. Assets are 200, liabilities are 135. What is your stockholders' equity? 65 is correct. Anybody need to see that? I'll show you. All right. Fill in the blanks. Your owner's equity, 65. All right, here we've got total revenues for the year, total expenses for the year. We want net income. Net income is equal to R minus E. 1780. Take away 865. Final answer, Regis? Meredith? 915. All right. You just did a balance sheet and you just did an income statement. The balance sheet has to balance, it's a scale. The income statement's net income equal to revenues minus expenses. Now we test your algebra knowledge. I'm back to A equals L plus OE. Total assets are 9 times total liabilities. 9 times. Liabilities are 70. Was on that road this morning. 9 times 70 is 630. Owner's equity is 560. You could teach this class. Good answer. Now, we're going to look at a balance sheet account. All balance sheet accounts work the same way. That is to say, we start with a beginning number, we add something to it, we take something from it, and that gets us to an ending number. All right, let me show it to you in the case of items. Okay, beginning items plus items in gives me items available. If I subtract from that items out, that will give me my ending items. What did I start with? What did I add to it? What do I subtract from it? That tells me what I have left. And that's the way that all the accounts on the balance sheet work. What did I start with? What came in? Take away what went out. That tells you what's left. All right? You could do it for cash. All right? Let's say we have beginning cash. Let's say we add to that cash receipts, CR, cash receipts, just abbreviating. That would give me my cash that's available. If I take away from that CD, he's our wrestling coach, that would give me ending cash. Well, how about we plug in some numbers? Suppose you started the month of October with $200. And what do your parents send you to live on? About $2,000 a month? Is that what you get from them? Well, then you have $2,200 available for October. All right. If you say, boy, at the end of October, I want to have $450 left, maybe you have a hot date. All right. You want to go to Topo, maybe see Jersey Boys. That'd be a nice night. All right. What would your cash disbursements be? How much could you budget for your cash disbursements? Gots to be $1,750, right? So pay your rent, pay your car insurance, buy your books if you haven't bought them yet. Are you with me? Some of you are looking at me like a blind man in a dark room looking for a black cat that isn't there. So we go over here and we look at retained earnings, and I'm going to set up the same schedule. That's the way they talk in the UK. Schedule. Would you like an ice cream with flake? What? It's an ice cream cone. Meet me at the lift. Wow. The elevator. You'll learn more than just accounting in here, folks. All right. I don't know if you can read that. Beginning RE is the abbreviation for retained earnings. I'm going to add to that net income. Okay, together that gives me my retained earnings that's available. If I subtract from that the dividends declared, that'll leave me with my ending retained earnings. If you always set these things up in the same way, you should never go wrong. Beginning retained earnings is 85. All right. Ending retained earnings is 121. Dividends are 25. I have dividends declared. That's DEC, the abbreviation, dividends declared. If it just says dividends or dividends paid, we'll assume that those are also declared. So if I work this backwards, I say to myself, 25 from what is 121? Got to be 146. Then I say to myself again, 85 plus what is 146? That means their net income must be 61. It's arithmetic. It's arithmetic that's built around relationships, though. All right. Take a look at the one on the bottom of the page. It's focusing on the assets and the liabilities and the owner's equity again. Stockholders' equity, it must be a corporation. Assets are 90 at the beginning of the year. Okay. Stockholders' equity is 15 at the beginning of the year. Okay, they didn't ask me for this, but can you look at that equation and tell me what the liabilities are as of the beginning of the year? Gots to be 75. Good answer. All right, then it says that assets increased 30. Well, that takes me from 90 up to 120. Then it says liabilities decreased by Desmond Tutu. That takes me down to 53. So I say to myself, you meet a better class of people when you talk to yourself. 53 plus what is 120? Come on, you can do it. 67. Could you do something like that? Speak to me, mutter a few syllables. I'm just like you. Everybody okay with that? All right, next page. NP. Next page. Total assets are 6 times total stockholders' equity. Total stockholders' equity is 15. What are total liabilities? Looky here. If my stockholders' equity is 15, hey, Vince Carter was 15. Total assets are 6 times total stockholders' equity, so that would make total assets 90. What are my liabilities? 75. Relationships. Same question pretty much that we had on the prior page, except now they're asking for the dividends. We'll start with beginning retained earnings. We'll add to that net income. That gives us the retained earnings that's available. If I subtract from that the dividends declared, which is what they're asking for, that gets me to my ending retained earnings. All right, well, if my beginning is 45 and the ending is 183 and the net income is 2 1/4, if I add 45 to 225, I get 270. I had to solve for that then. 270 minus what is 183? That answer would be 87. Same thing here with cash. Look, we start with beginning cash. We add to that CR, cash receipts. That gives us available, if I subtract from that CD the cash disbursements, that gives me my ending cash. Can you plug in the numbers? Well, the beginning cash is 47. The ending is 68. The disbursements are 118. I'm subtracting 118 from something to get 68. The available has to be 186. That means my cash receipts have to be 139. All right. The fourth question on that page looks at the statement of cash flows. And we said that the statement of cash flows measures changes in cash among operating, investing, and financing activities. Well, if I have a plus 86 from operating, a minus 65 from investing, and a plus 37 from financing activities, if I net those numbers together, I'm going to get a plus 58. 86 take away 65 is 21, plus 37 is 58. Well, if the beginning cash is 200, and I add 58 to that, I've got my ending cash, which is 258. Okay? The one on the bottom of the page you should be able to do. Okay, do it with me. Assets at the beginning of the year, I'm going to just write A equals L plus OE. My assets at the beginning of the year are 80. Stockholders' equity is 27. What are the liabilities at the beginning of the year? 53 is right. It says the assets increased 30. Well, that takes me up to 110. Oh, Derek. Liabilities decreased 22. That takes me down to 31. What's the owner's equity at the end of the year? $79. Very good. Does everybody see that? It's arithmetic built around relationships. That's all we're really looking at this point. A balance sheet has assets equal to liabilities plus owner's equity. Assets are economic resources, liabilities, creditors' claims, owner's equity, owner's claims. Income statement, revenues minus expenses. Net income is revenues minus expenses. Statement of cash flow, we're measuring changes in the cash account in 3 flavors: operating, investing, and financing. 3 statements are connected, and we showed that on the far right board. Okay. The next question on the next page is a little bit of a challenge, but something that you should be able to handle once you see it worked once. It says, on January 1st, a company was started with assets of 60 and liabilities of 18. I'm going to do this. I'm going to set it up and say on 1/1x1, I've got assets of 60, I've got liabilities of 18, and then I'm going to break my owner's equity into 2 pieces. I'm going to have CC for contributed capital and RE for retained earnings. If I were to define retained earnings for you, I would say that retained earnings represents accumulated net income in excess of dividends. You just saw that in the questions when we were asking about the retained earnings account. So when you start your business, guess what your retained earnings is going to be? 0. Accumulated net income in excess of dividends. So when you start at 0, so that means we could have plugged here for the contributed capital. The first question wants to know the 1/1x1 retained earnings at 0. The contributed capital then would have to be 42. There's your balance sheet. Balances, 60 is equal to 60. Assets are equal to liabilities and owner's equity. These 2 guys taken together give me owner's equity. Well, then at the end of the year, it tells me that I've got assets of 95 and liabilities of 30. Now remember, the scale still has to balance. I'm told that there were additional investments by owners of 12. That means that the contributed capital at the end has to be 54. And now I'm back to my original assets equal liabilities and owner's equity. If my assets are 95, my liabilities and owner's equity also has to be 95. I've got 30, I've got 54, I've got 84. Say to yourself, what plus 84 is 95? What are the ending retained earnings? Gots to be 11. And then it asks for the net income. Well, you know how you're going to find net income? You're going to look at that retained earnings schedule and you're going to say beginning retained earnings plus net income gives me an available number minus the dividends gets me to my ending retained earnings. And here's what I know. I know that my beginning retained earnings is 0 and the ending is 11. And the problem tells me that the cash dividends paid were 9. So what is your net income in that case? You're using the relationships between the balance sheet and specifically the statement of retained earnings to get us what we need. 9 from what is 11? The available has to be 20. 0 plus what is 20? Answer, 20. All right, you follow that? Okay, at the bottom of the page, there are a couple new definitions for you. Working capital is current assets minus current liabilities. Current ratio is current assets divided by current liabilities. CA, current assets. CL, current liabilities. Again, folks, it's an algebra question. You're saying CA minus CL is 33. You're saying that CA divided by CL is 2.5. You got two equations, you got two unknowns. You can solve that for one unique solution. How? Let's take this bottom one and multiply both sides by CL. Then I'm going to have CA is equal to 2.5 CL. And then I'm going to substitute 2.5 CL up here in for CA. So I'm going to get 2.5 CL minus 1 CL. Coefficient 1 is understood, is 33. 1.5 CL is 33. My current liabilities are 22. Okay?
Could you explain why current ratio, what is really current ratio? I mean, you've shown the definition, but why does anyone care about it?
It's a relationship. It's basically a safety thing. All right? If you have a current ratio that's greater than 1, that means you have enough current assets to satisfy all your current liabilities. Current liabilities are things that you're going to have to pay within the next year. And so if your current assets are greater than your current liabilities, you can take care of all of those things that you owe money for in the next year. All right. And then we can substitute back into either of these things and come up with current assets. That's got to be the double nickel, 55. So then what? Well, if we lay out what we have current assets sitting at 55. We have current liabilities sitting at 22. We have a working capital number that's 33 and a current ratio that is 2.5. The next question says, what is the effect if inventory is purchased on account on the last day of the year? Let's say on the last day of the year you buy 20 of inventory. Well, that's going to make your current assets go up to 75. Inventory is a current asset. It's going to make your current liabilities go up to 42. The accounts payable is a current liability. The working capital won't change. It's still 33, but my current ratio now is going to go down. Whatever 75 divided by 42 is, 1.79, has a decreasing current ratio. All right, start with the same 55 and 22 and working capital of 33 and a current ratio of 2.5. And the last question on that page says, what is the effect on working capital and current ratio when a short-term note is paid off on the last day of the year? Okay, suppose now you owed somebody 15 and you paid them off. Well, you paid them off with cash, so your current assets would go down by 15 to 40. Your current liabilities would go down 15 to 7. Note that your working capital is still 33. But your current ratio in this case has gone up. Now it's going to be 5.72, 40 divided by 7, 5.714, so close. All right, so those show some changes. I'm going to leave the 5th page for you. I'll talk about the first 3 questions just so you have heard these terms and have some exposure. But the stuff that's on the bottom of the page with beginning and ending are 3 problems that I'd like you to work for our next meeting. We have in accounting something called a T account. Debit items are on the left and credit items are on the right. All right, and what we do with this is we set up a model where we have assets that increase with debits and decrease with credits, and then liabilities and owner's equity that work in the opposite fashion. The revenues and the expenses, because we defined revenues as an increase in net assets, it works the same as owner's equity. Revenues minus expenses gives us net income. They'll work in the opposite direction. So what we have are assets and expenses that have what are called normal debit balances. Okay, a normal balance is the side on what it increases. A normal debit balance account increases on the left. A normal credit balance increases on the right. Now, I'll be giving you some stuff to read with respect to these things for the next time, but I just wanted you to be exposed to those things as we end up today. I'll do one more little example with you, and it relates to the company that's starting out, and I'll ask you to call out answers for these. Suppose I tell you that a business starts on 1/1/1 with assets equal to 100 and liabilities equal to 30. All right. And I'm going to set it up just like we did the other problem. I'm going to have my assets, my liabilities, and then I'm going to break the owner's equity into contributed capital and retained earnings. Here I am at 1/1/1, and my assets are 100, and my liabilities are 30. Can you tell me what retained earnings is as of 1/1/1, the day we started the business? 0, all right? Can you tell me what the contributed capital is on 1/1/1, the day we start the business? 70, okay. Then I'm going to tell you during the year 2 things happen. During the year, additional investments by owners are equal to 17, my favorite magazine. What will my contributed capital be at the end of the year if I add those additional investments to it? 87. Okay. I'm going to also tell you that during the year dividends of 10 were paid. And I'll tell you at 12/31, you've got assets equal to 200 and you've got liabilities equal to 36. All right, so I'm going to drop my 200 in there. I'm going to drop my 36 in there. And now, can you tell me what my ending retained earnings is in this case? I know the total has to be 200, so these 3 guys have to add up to 200. 36 plus 87 plus what is 200. $77, good answer. All right, and then the last question, what is net income for that year? Well, if we use our schedule where we take the beginning retained earnings and we add to that the net income, that'll get us available minus the ending, minus the dividends, will get us the ending retained earnings. My beginning retained earnings was 0 and my ending was 77. I told you the dividends were 10. What then must be available and what then must be the net income? $10 from what gives me 77, 87. 0 plus what is 87? 87. You're there.